Hi, this is Randy Finney with the right side of the chart, and today is Monday, March 13th, 2023. It's 11:23 a.m. Eastern Time as I'm starting the video, and I'm just going to kind of ad-lib this one, and gosh, there's so much to talk about, and I don't even know where to begin, but we're going to start as I usually do with the equity markets. I won't make it a super long video. I'll just kind of hit on the big things, where the opportunities are, the assets that I cover most often, such as the equity markets, gold, crypto, treasury bonds. What else is there? Well, if time permitting, I already got the natural gas trade out to you, so no updates there. So far, so good. Let's start out with the equity markets, and first and foremost, where we're at technically. Technically, we are well below. We have fallen, as obviously Friday, we fell and closed solidly back below both the primary downtrend line. There's my clean chart. I'll make it yellow like the other board. Very, very well defined downtrend line on the bear market there. Yeah, breakout back test. So the breakout failed Friday, and again, it wasn't like close, and we're still below there. So I am viewing this rally, and we're also, of course, below that 200-day moving average. And as I said before, it's not an all or none event. It's more incremental. The farther we go away, they're obviously buying up the dip today so far. But I will say that just as I told you, I favored going short into the weekend, and we started out down, and you could have covered, or we're back up now, but I still view this until and unless we recover. I view this as any rallies back into resistance, which I'll get to in a second. I view those as shorting ops. The bottom line is I'm not going to go over what's gone on with the banks. I'm sure if unless you've been away on a trip without phone or TV or internet access, what's gone on with the regional banks, and then what the FDIC did this weekend, stepping in to shore up the banking system. But that, I've read through it, and my take is it's nothing but a net negative. There's no net positive, but the markets do this every time the Fed comes in. Here's my mindset real quick. SVB, Silicon Valley Bank, was we'll call it a black swan, whatever you want. It was not priced into the markets. Sure, you could see the stock starting to drop before that, but the markets took it as a big shock. So did the FDIC and everything on Friday. And so where we were before that, we were already in a downtrend. We were, finished what appeared to be a bear market rally, and we had been stair-stepping lower. So, what basically with the FDIC shoring up the banks to an extent, but of course if you read through there, they said no taxpayer bailouts, or the taxpayer won't bear the cost, which ultimately we will, trust me on that. They always do that. But the banks, they said, are going to have to pay for this via additional assessments, all the other banks, for what they're doing now, and basically extending FDIC coverage to all deposits instead of the 250. And again, I've thought through this 6 ways to Sunday, and I see no net positive for the markets or the financial system or banks, just a net negative. But there, again, I've done this often. I've done this many times, I should say, been through such things, and you're always going to get that initial, okay, the Fed stepped in, and once again they're going to save the economy. The Fed created a mess that is just only starting to unwind. Again, my take, and maybe I'll be wrong. Only time will prove. But I've predicted since the top came or before it would be a much longer downtrend, much longer bear market. The implications of unwinding of the massive credit bubble the Fed has created, and the excessive fiscal stimulus, as well, that from DC when COVID hit. This is just 2008 all over again. The Fed created that bubble. That was at the time considered the biggest financial bubble in history. It wasn't just a housing market bubble. It was a massive credit bubble. And so when those things unwind, the way they've done it this time, it's been a slower roll, but a much bigger bubble, really. This is just everything up and through until COVID, which ended with the nuclear response, was just an extension of the easy money policies and put into place back in 2008. So, all right, we could talk on it all day long. That's fundamentals, and that's what the folks on CNBC do. They banter back and forth. give their 2 cents. At the end of the day, I'm just going to show you, say we're below here. So any rallies back to resistance until and unless this gets, as I said last week, a solid recovery back above the 200-day moving average, which is right here, the blue line, and the trend line. And even then, there's just a mountain of resistance overhead. We could continue to slog around for a while, but I can tell you that anything's possible. But with the way the VIX has exploded, I'll get to in a second, everything else, that's more indicative of that we're going to go lower in the coming days to weeks. So as of now, and if that changes, I'll let you know. I view this as any rallies back into resistance, and I'm going to go over those resistance levels in a second. We'll zero in on the 60-minute chart. I can tell you right about there is pretty darn good. You have a whole mountain of resistance on the daily. You have the 200-day moving average, which once we broke it on Friday, we back tested it and got rejected. Well, actually, we broke it on Thursday and closed below it, but then right on the trend line, and then you can see failure, move back below the trend line. So this is a lot of resistance, and I think you have a lot of short covering today. Worries that what else is the Fed and the market going to do? The government to in somehow kind of stabilize the financial markets. But again, right or wrong, I think it's I see nothing but a net negative in what's gone on in the banks recently. All right, let's just go to some levels, some micro levels, we'll call it. 60-minute chart. There's the primary downtrend line, at least the way I have it drawn on the 60-minute, and a little bit of a busy chart, but I'll tell you right here, you can see a couple big reaction lows, the downtrend line. Again, it's more of a resistance zone. There were some bullish technical developments recently. On SPY, you were very oversold here on the 60-minute chart. Even in a downtrend and a bear market, you get extremely oversold. PPO comes down to this is the level I've had here forever. It's negative 1.0 on the PPO. That seems to be about usually the downside that you get to there. So again, it's in my opinion, a reflexive bounce, but we're still above key support. And when I go back to the daily, let's not forget, so everything that happened besides the breakout, back test, and now back test, which has failed. So that makes this, as of now, unless we recover back up here, and maybe this will be another whipsaw, we'll see, but as of now it's not that yet. But you had the false breakdown, that's bearish. You had recently the break above the uptrend line off the lows. You can see that there. You broke down here, back tested, rejected, and so we're moving lower. So that's it. That's my view for swing and trend traders, is that view rallies back to resistance unless those resistance levels are taken out, is objective shorting entries. And then you have the downtrend line on QQQ, primary downtrend line. You have quite a bit of resistance here too, around 296.50, but mainly that downtrend line. PPO made that bearish crossover, which is still in effect. You can see here, and we haven't yet made a bullish crossover. Remember, this is one thing I've highlighted all these in recent months. These bullish and bearish crossovers is a great trend indicator, especially when you get the clean hills, not during periods of consolidation. That's where the crossovers that's where you get more whipsaws like that. But when you have these big clean green hills, and then the red hills down below, inverted hills, we'll call them. I call them hills, mountains. There was the last one right there. And so, excuse me, that is still in play. That's saying we're still on a sell signal, if you will, from this one indicator. And so therefore, as such, I view rallies back into resistance as objective shorting ops. A glass half full case, the reason for the rally, technically induced, is you had good support. There's a support level I've had here for a while at about 285.60. It created that back on January 4th. That line right there, it was support resistance all along, and we hit it, and we hit it with positive divergence. So this is where buyers are stepping in, but again, I'm sort of overriding, and call it bias, call it what you want, but it's more of experience of where we're at with the bigger picture, with what's going on. But I'm overriding what, to me, you guys know that I love these 60-minute divergent lows and highs. Even in a primary downtrend, these 60-minute divergent lows are usually where I look to cover shorts and go long for the next swing trade, 5 to 8, maybe 10% plus. And at this point in time, I can tell you we've rallied right into resistance. So I came into the day short. I didn't cover those shorts yet. Unfortunately, I wish I could have told you I came the bounce off the bottom, but I didn't. But I did just add to those because I didn't go crazy short. To go crazy short over a weekend, you just can get clocked had we gapped up really big. And so there it is. Here's your resistance levels. And this is where it starts to change. If we get over that downtrend line, it's not a be-all end-all level, but it's big. And 303, that is the really big resistance, in my opinion, that should cap any rallies, although I don't think we're going to get that high. I think they're going to sell into this rally today. Right now, this is an objective place right over here around 293. If we go higher, the next resistance, and it's really good resistance too, is 296. That's where I'll be deploying the last of my dry powder, and above here is where I start to scale out of those positions, realizing that, hey, something else may be going on. Okay, so that's pretty simple. It's a trading plan right there. There's your downtrend line on SPY 60-minute chart. There's the primary. Remember, the primary downtrend line is more. That's a very big level, as is 393.50. So just a mountain of resistance. Yeah, oversold. The dip buyers do what they do. And again, it's technical. So you get that oversold. Algos fire off. Algorithmic trading programs and then the high frequency trading, they see a little move reversal, they jump on that side of the trade, and then as soon as it reverses, they're going to jump on the other side of the trade. So all right, you guys have my thoughts on where we're going on the markets and what to do. You do what you want. Obviously, I'm going to be right or wrong. That's the only guarantee I'll ever give you. This is a 60-minute chart at NQ. I just want to show you levels if I have anything marked. There's your primary downtrend line right there. Remember, on QQQ, you had a third reaction you didn't hear. So you had a little bit of divergence here on the 60, but that's typically not the kind of divergence that gives you a rally. This is a bigger divergence, and you had that nice rally, the trend line break. And again, the fact they sold into that one pretty hard and took out the lows. Now we're above it, but you can see here we're at resistance there. I'm just showing you there's a lot of levels on the chart. Anything's possible, but I favor again shorting into resistance as soon as where we're at right now, because that's pretty good resistance. I think that's going to be about it for today. Just my 2 cents. All right, next up. ES. Oh, and then I'll get to RTY, because the small caps are where they're getting hammered because they have a lot of the banks. Remember, the NASDAQ 100 for the most part doesn't have any financials in there. It's if there is, it's like less than, unless anything's changed in recent years, it was less than a 1% weight. There's virtually no financial stocks. So in times just like back in 2008 was a rare instance where the S&P 500 fell as much as a tech-heavy NASDAQ 100, which usually goes down more in bear markets and corrections, and that's because it was all mainly about the banking sector collapsing back then. So that's why you're getting more juice right now, and that may continue. I don't know. I don't have much of an opinion. I do think that in the last day or so, financials have outperformed to the downside, and those indexes like the S&P and the Russell 2000, which has more of your regional bank stocks in there as well. But I do think the next leg down we'll start to see a lot of money come out of the big heavy fangs. So I favor at this point staying, going with an NQ short. Nothing wrong with I'm speaking in future terms. QQQ would be the ETF for that. You can certainly use SPY and ES, but my preference is NQ in the techs, because I think if there's another leg down, that's where money's going to come out of. And it's also just simple mathematics. They are the top weighted components, the big tech stocks: Apple, Microsoft, Alphabet, Amazon, Tesla. They're all going to go, they come under forced selling when the market goes down, and that tends to bring the NASDAQ 100 down more. And then of course IWM and RTY, I'll try to get to those in 1 second for you. So there was some divergence, certainly here you can see on ES, the S&P 500 futures, and that divergence is so far played out for this. But here you can see we're coming up support levels here. I'm sorry, resistance, and you have there's that primary uptrend line right there, just a mountain of resistance. And again, my preference is we've probably seen most of the rally today, but if we go up more, like I said, I have room to deploy some more dry powder, and then at that point I'll stop where I showed you on NQ. Let me show you RTY for a second. RTY, Russell 2000, that's just a short-term chart showing a five-minute chart showing a little divergent low. I'm going to flip to a 60-minute, just trying to get my trend line tool there, a little divergence, especially right there on the bottom and right there. And how far does it carry us? I start to put a little less of a focus on the 5-minute and very short-term charts now, and as I told you last Friday, because I've morphed more away from active trading mode to swing trading mode. Either this breakdown in the S&P 500 sticks or it doesn't stick. Again, if they can rally back up, take back the trend lines, the 200 days, that's going to be pretty powerful stuff. So just stay flexible, as I often say, especially at times like this. You know, being rigid and married to any one thing that the market must do this, must do that, can get you crushed when especially when volatility is high, because that's when the market moves fast in either direction. All right, this is a hourly 60-minute chart, 3 months price history. There's a pretty strong positive divergence there for RTY at really good support too. So I'm going to say this, as I often do with my little quotation fingers. This is where the bulls, quote unquote, should be stepping in, and stepping in hard with both fists. This is a great support level. That is big support. That was a major bottom right there. From there, the small caps rallied approximately, where's my pop-up? Something's going on here. One sec. Okay, there, I couldn't see it. It was right there, 16, about 17%, give or take. And now back to that level. So again, very well-defined support level with positive divergence. So you might want to wait till that goes, especially if you're not short already, the Russell 2000. If you are short, you want to ride it out in expectation that level may give way, but that's, I just zoomed out to a 6-month chart with 2-hour candles to show you that was a major reaction low. And again, on that 60-minute chart, you have positive divergence. Let's look at IWM for you, and then we'll move on to a few other things and wrap the video up. IWM, there's a level I've had, 173.48. I created that level back in May of 2022. It looks like I might have tweaked it in October. It says updated. I don't know if I moved it. It was obviously a very good support resistance level, but it kind of crossed through the middle of that zone, but still, for whatever reason, I had it there, and that's where we reversed. But this is where I'll put it right now. I'm going to update it because it should be towards the bottom of that consolidation zone, right about there. Come in, capture these candles right here. Let me show you what I spy with my eye. 1, 2, 3 major reaction lows, and that aligns with where I had it on RTY, and that's it. We hit it there. Deeply oversold. This is the deepest oversold reading on this 60-minute chart that we've had since back here, right there. And we had a bullish falling wedge, which we broke out of. Now we go to the daily chart. Let me move this histogram, park that to the side. We don't need that. Let me go to my primary board, and here's what I see. Just like the S&P 500 and NASDAQ 100, we had these trend lines off the lows. They've been broken. So this is it in a nutshell. I'll repeat myself. We've broken, a lot of support levels. We've given back the 200-day moving averages. There's the exponential. We bounced on it for a while on IWM, the small cap ETF. Then we parked it on the 200. That was the exponential. 200 simple moving average is right there. Then we gave that up, and then we took out the trend line. That's one fell swoop. See, again, these have a lot of these regional banks. And as I said before, this is just me. I'm not an expert on the banking sector, but I have read through what happened, and I see it as nothing but a net negative for the banking sector, despite the fact that the FDIC is going to extend backing to amount over, at least to those two banks. I did hear an former FDIC, I forget his exact title, but they can't possibly extend FDIC coverage to all uninsured deposits on all banks. They can't do that without congressional approval. Anyways, it could get ugly. There's the major bear market bottom lows so far, and that so basically that's it. We're down to that previous reaction low, and if we take that out, then you're going to have really early stage really end this uptrend. If you look at it here, I'm sorry, I'm going to make that a little more clear for you. An uptrend, off the lows, the small caps have been making higher highs, I'm sorry, and higher lows. So if they take this one out, then that kind of foils that and will most likely run at that previous low right there. But if they can step in now, they keep that low intact. So you got to give them that. They still got a lot of work to do to take out that previous high. So again, as I said, we just reverse off really good support today. So at this point, you have two objective short entries on IWM. The next drop below there or rallies back to resistance. This is good resistance right here. It's that same trading zone I was talking about right there, trading range. And that top of that's 177.05. And then you have the uptrend line just above it. So this is in my opinion, a very objective level to scale into or initiate shorts on the small caps there, with a max level up here to the downtrend line right there. Okay, let's go to the metals real quick. Let's talk, well, let me go to the futures, start out there, because GC, as I got out to you this morning, was coming up on this 1914 resistance. That was a big level to me because that's where we had this break right here. We had set up, we had several reactions there. It was support, came right after the trend line break, and that started, really kicked off this wave of selling right here. This is the first rally back to it and negative divergence. I believe that was all covered in the chart. So to me, it was an objective level to book profits and game a quick short pullback trade. I remain longer term bullish on gold and silver, like I said this morning. Minor pullbacks and zigs and zags aside. So for example, if we get a pullback, I'm trying to draw with an arrow tool. Pull back to support somewhere in there. Maybe there's a support level right there I need to add, and there's looks like a little gap. The only time you see gold gap is on the weekends because it stops trading, over the weekend. The gold futures, of course, and that's it. Next resistance is up there. Silver, if gold pulls back, silver's likely going to pull back as well. So I just right before the video reversed those only for very quick. There's I should say this. You got to be very careful shorting the risk-off trades now, despite the rally in the market. And that's the other thing too. If the stock market keeps rallying right now, you're going to see a pullback in the risk-off assets. That's what's going on right now. So Treasury bonds I just shorted. I'll get to that in a second. Gold, silver. After closing out gold and silver, I wish I was long Treasuries into today. Closed that out too early, even though I highlighted that as being taken that long a few days ago last week. I'll get to that one second. But so the stock market's rallying. It's almost a hedge now to my shorts, my index shorts, because if the stock market continues to rally much more, you're going to see money come out of these flight to safety assets. And what I'm talking about, I know I'm all over the place here, flight to safety assets are gold, and of course silver is going to follow gold. So gold, silver, precious metals, more so than the miners. The metals in times like this, you tend to have, that's what people are buying, mainly gold. And then you have Treasury bonds are one of the king of risk-off assets. And right now, we're seeing, I'll get to crypto in a second. I don't want to make this video too long, but with the worries about, is my money safe in the banks for the first time since 2008? Because that is truly the first time. I'm sure you've heard by now, but Silicon Valley Bank was the second biggest bank failure. Either the second biggest since that financial crisis or the first since then, whatever. It was one of the biggest. And then of course there was another bank that folded. I think it was the one that I highlighted in the video on Friday when I showed you how to go through the regional KRE, the regional banking ETF, and that other, what was it, one of the other banks that they shut down over the weekend as well. So anyways, these are your risk-off assets. They tend to go up during times of market panic or volatility when the stocks are dropping. And now at this point, as I'm doing this video, they're still at their highs for the day or right off them. And yet the market's continuing to move up. The market's at the high of the day. So sooner or later, if the market keeps going up, you're going to see money start to come out of these profit taking, saying, oh, poof, everything's okay. The Fed saved the day. So anyways, I'm viewing this right now, as just, even though I was long these until recently, or these two until right before this video right now. I think they will offset any further gains being short of those, any further gains in the equity markets at least. But I would never randomly short something just for that reason. I have to have a reason, a technical case. And so here's silver. What am I on? A 5-minute chart, a short-term chart, negative divergence. And so we're at the highs, probably get a pullback in silver. That's just a very short-term chart, but it helps to confirm, getting in there. Hourly, you have right here, I showed you the divergent low recently, and it's been a nice run. There's 10% in just a couple days. That's again because gold's moving and silver's following, and then, as I said, you typically get more bang for your buck with silver. Not always, but usually. And what I'm doing here is that's a nice resistance level, and we're very close to it. So again, very overbought near term, so I'm just looking for a pullback in silver. How far? I'll gauge that as it comes. No more than this right here, this previous reaction low, probably to about right here, because especially if the market rolls over, and that's what I'm trying to get at here. I know I get very wordy. There's a lot of moving parts here. If the market starts to take another sharp leg down, you'll probably see money siphon or reverse right back into these risk-off assets. So there's silver. But more importantly, if you're going to trade silver, keep an eye on gold. And again, there's gold at pretty darn good resistance. Should it pop that, it has even bigger resistance there. Like silver, it also has negative small divergence here on the 60-minute chart, but it's certainly negative divergence, and that shows even better on the shorter term if you go to a 15 or 5-minute time frame. So that's that. So again, I remain intermediate to longer term bullish, but just looking for likely a pullback there. All right, what else is there? There's crypto. All right, so I threw out Bitcoin, told you can take a shot at that with a stop over the trend line, and it popped that trend line right away. That's the actual crypto. Let me give you the Bitcoin futures and show you what's going on there. Okay, I've just updated this chart. I would use a max stop on a 60-minute close above this level right here if you're trading a 60-minute time frame. Oh, this is actually a 2-hour chart, but still probably go with the 60-minute close. So that's pretty decent resistance right there. We did pop the trend line. So if you stopped out, good for you, because that's really, once you popped it, it was a well-defined trend line. You were likely to get a spike. But if you did that, if you give it a stop to here, that's using a decent RR, about a 2-to-1 if you're targeting a move down here. So Bitcoin's catching a bid from those people, again, as a flight to safety bid. Forever and a day it was, or at least since the bear market started, it was moving in line with equities. But right now everything's kind of screwed up, if you will, with the banks failing and all that, and a couple, not all of them, obviously. But the worry is there. So Bitcoin it's getting that. There's no other alternative bid. There are people that, one of the draws to Bitcoin, and I get it, is it's not controlled, by the government. So it's a way to, put your money somewhere that if the banks go to zero and collapse, or the dollar goes to zero, because all this ultimately is bad for the dollar. What's going to happen is that the government cannot afford to let the U.S. banking system fail. The whole country would be, it'd be Armageddon here, obviously, if the banking system failed. The whole economy would come to a halt, and there'd be, mayhem and everything. So we know that's not going to happen. Now what'll happen is the taxpayer will pay for it. The government will bail it out, and then that ultimately it's just going to be bearish, if you will, for the U.S. dollar. Just means our IOUs are just that much worse. Our financial house will be in that much worse order. So anyways, that's where we're going, and that's where people are going on that bid. But I also will say this, let me just kind of get ahead of myself here, is the more you see Bitcoin go up, the more money that goes into these. I don't have to tell you the problems that we've had in crypto land lately, but the government will not allow a viable proxy to the dollar. They've been trying their best to stop it, but they can't possibly. If all the money starts going out of the U.S. banking system, because people think there's money not safe and everybody's piling into Bitcoin, the government's going to put an end to it, just like China did. So I'd be careful with that. And you can also, that is resistance. If you didn't short it there, you could certainly short at this resistance level. I just wanted to say that's what's going on there. And let me show you GBTC. GBTC is the Bitcoin proxy. You can see it's got pretty darn good resistance here, right there. I call it a Bitcoin proxy. It's a as you probably know, it's not an ETF. It's an ETF-like instrument. They're expecting maybe this fall that the SEC will approve them to be an ETF, but until then, it's similar to closed-end fund where it trades at a discount or premium, but usually a discount to the net asset value, meaning the value of the Bitcoin. And that's it. I can tell you, look, from a 60-minute chart, you've got a lot of big negative divergence. You had a divergent high right here, and you had a correction right there. And now this is even a larger divergent high right there. And so if it happens to push up anymore, next resistance is there at 13,390. And I think a back test of this trend line right here and maybe a move all the way down here would be a likely target for Bitcoin. Ethereum, at least ETHE, you have to give it this. It took out this trend line, but if it fails that breakout, that's going to be bearish. And this doesn't do a perfect job of tracking Ethereum, so maybe the trend line, if you want to give it the benefit of the doubt, something like that. There was divergence and everything else, and that's what gave us that rally right there. Let me show you the futures. That's I trade. I don't care for these guys. ETH USDRR. Here you go. You have a downtrend line similar to what you had on Bitcoin, and we're a little bit above it, but not by a lot. If we go up and take out this previous high anytime soon, it's going to extend this. There was negative divergence right there at that high, and any marginal new high, I should say, only marginal. If it goes much more than that, it'll take the divergence out. You can see we'll still have the divergence there. So that's the story on Ethereum. Had a break of this trend line, whipped back up today. This is the result of an expansion in volatility, an explosion in the VIX. Like I said, was very likely, and that's what we got. Here's the VIX. Look at that. Boom. Last highlighted there is an objective long entry if you trade any of those VIX ETNs or anything. Or the futures. I like VIX futures. That's my preference because ETNs have blown up in the past. They're not guaranteed. ETNs are just an IOU. It's a bank note. It's an IOU from a bank or the issuer. And I mentioned this before. A few years back, we had a couple of them blow up during a sharp move up in the VIX. They just couldn't keep up. They weren't hedged or tracking it properly. And so instead of making a fortune when the VIX shot up, you actually lost everything. So got to be careful with those. VXX was around then, still is now. What I would stay away from is the leverage one, that TVIX or UVIX or whatever, UVXY. You don't need leverage for the VIX. It's like natural gas. It's so volatile. You don't need the leverage because the underlying in itself is so volatile. But there it is. So we hit that next target I had of 28.84. This one's a little delayed, 15-minute delay, but I can show you a live chart of the VIX. I've got different charting platforms. I have it, and I will right now if I can find that for you. Here we go. Boom. There is that. I think I would have laid that target out. I haven't updated this today. Last week, hit it to the button. 27.40 right there. Okay. Had that little pause snafu where I paused the video and the counter it's not recording, and so I don't know where I left off, but I know I was talking about the VIX recently, and so some of this might be repetitive. But here's the VIX. Last mentioned there, well, not last mentioned, but mentioned here on the pullback to as an objective long, and also to coincide or correlate with the reversal in the stock market, with the VIX being at support following the breakout of the bullish falling wedge right there. And then, so like I said, VIX, I said don't underestimate how fast it can go up, and so far that's what it's done. It's shot up since that point. This one's delayed. I'll get to the real-time chart. That's what I was covering a second ago. Didn't realize the video stopped recording. It's about a 70% move. Trendline resistance 37.61. And whether we're going to take out that key level right there, 37.61, will depend on whether or not the markets are going to take another leg down. If they're going to do it, I think it'll be soon, by the end of this week. Who knows? We could reverse today. We'll see. But then the live chart of the VIX futures right here. This is the hourly chart. Shows you the divergent low. Let me see. I thought I had a board that had more annotations. It might be a. There it is. Okay, 2 hour candlesticks. That shows better. There was your downtrend line, bullish falling wedge pattern right there, and breakout. Rallied right into that. If I covered this last week, I should have had that level on there. I haven't. This was on there from last week. 2740 as a potential target, and we hit that pretty much to the button today. Pulled back, and now we're at support. These were my resistance levels on the VIX. These are the April contracts, I believe. Yep, the April contracts right here, and boom, boom, boom. So. This is a likely place to see a reversal, and should we come back here, possible, certainly possible. That would also be potential. I wouldn't chase it here. If it goes up much more, even right now, look, I'm showing you where support is, where the market's likely to, the VIX may bounce and the market may reverse. But what I was saying, and I think the recording was stopped, is that when the VIX has run up about 36% in just a matter of a few days, you don't want to chase it. If you weren't long on the pullback to support recently, the major support, the uptrend line, everything else, or on the breakout, or heading into before Friday's big drop, the VIX, when it reverses very hard, and it's very hard to trend trade the VIX because it's so volatile. The pullbacks are usually measured in the double digits, so that's going to stop out most traders. So and if volatility abates too much, then maybe the whole move is over. Maybe this is it. I don't think this is it. Again, I think we're going to see there's limited upside in the stock market. The VIX is pulled back to support, as I showed you on that 60 or 120 minute chart, and I think we'll most likely take another leg down the stock market. Rally up here. Next resistance is the downtrend line. Then this is big, about 37.60 right there. Previous highs right there in the VIX. And if we're going to take that out, it's going to take another big leg down in the stock market to do so. It would take the S&P heading down. This is a weekly chart. There we are, still below resistance. We'll probably come down and hit these next targets that I have on that I still maintain, bear market targets, long-term T2, long-term T3. This was my initial long-term target for the bear market we hit, meaning these were just near-term targets where we gained bounces. This was a long-term target, so I expected more of a reaction off that, and then long-term T2, T3 down here, and then on QQQ, just to reiterate, that was T3. There was big divergent low there, and this is still my well, we're getting close. My fourth and final target since the bear market started was either 235-ish level right here, or the blue uptrend line. And so the blue uptrend line is most likely going to come in first, but you know what I might do, and I'm going to do it now for you. I'm going to tweak that trend line, and I'm going to come in. What am I doing? What I'm doing here is I captured, I made a better fit to all these lows. I always had it off these lows right here and this one. I noticed just now I was a little tight right here. I came in on that trend line right there, tried to tighten it up a little bit. So they may come in together. It's not a hard and super well-defined trend line because I can't make it fit both of those. But if we have another leg down, let me just say I think we'll go down here to 235, which is what I call the pre-COVID highs. That's right before we fell off on COVID. And that's really what I was targeting all along. When I laid it out here, the trend line and that level came in together. So it takes a while. This bear market's playing out. Pretty a slow roll so far, and I think we're going down there. You can see from the PPO trend indicator, everything I've covered recently, we're still below and back testing the zero line. That often defines when you're above it, you're in a bull trend, and it's the white line. When you're below it, you're in a bear trend, and it often acts as resistance. So this is where it's make or break it for the bulls or the bears. Bears need to keep us down below those 200-day moving averages and the trend lines. Bulls want to regain those, and you know which way I favor right now. If and when that changes, I'll let you know. Last but not least, it's been a long video, but I want to just get it all out there for you. Treasury bonds. This is a highlighted last week. You know, it was bullish with the breakout here. We put in a divergent low breakout. We back tested that 124, 161 level. I pointed out for you somewhere in here, and then boom, it didn't look back. I was long and took profits a little too early, but as I told you, I just shorted it for the reasons I said earlier in the video. Not super confident, but again, it's more of a hedge, if you will, to the index shorts. And when you look at the shorter term charts, this is a, well, let me go to the 5. It was a 5-minute chart. Also confirm we had some you know, extreme, little bit of a divergence right there on that most recent high. And I have another board. Oh, here it is. I know what it was. TLT. TLT is at pretty decent resistance on the daily right here, and the weekly. I just showed you it was the weekly there. See, you have this little purple downtrend line right here. There it is. And so we've rallied into that downtrend line on the weekly chart. We are also at big resistance right here. You can see this level. Really, I can pull that line up a little bit, and it caps all those recent highs. 1, 2, 3, 4, 5 right there. So like I said, treasuries could certainly continue to go up, but more than likely if they go up, that's because the stocks are falling. And right now stocks are at their highs for the day. Treasuries are just off the highs. What is it, market? Do you want to go risk on or risk off? It's rare to see both happening for too long. Okay, I'm going to stop it here, 41 minutes, but those are the big things, like I said, and I didn't cover natural gas because that was put out, you know, you have the levels there, and I did follow up with the targets for UNG, and I even added an additional target on UNG, which I'll probably correlate that and add it to the natural gas chart a little bit if that trade continues to work out. This has been Randy Finney with Right Side of the Chart. Have a great day.